Forex trading journey, you will have both ups and downs. It's easy to get distracted by the different trading methods out there, so you need to make sure you have a trading plan that you stick to, whatever the circumstances. Here are our 5 golden rules for building a successful trading plan. Golden rule number 1 is to keep it simple. You don't need to be a quant, creating complicated algorithms or game theory scenarios for every single trade you place. Simply find a strategy that is straightforward and easy to execute for your particular risk tolerance and trading objectives. Secondly, do your research. By watching this video, you're moving in the right direction. But the more you research the markets and news flow, the more fluent you will become in understanding what makes currencies move, increasing your chances of identifying trading opportunities. Third, be realistic with your goals. Simply stating that you want to double or triple your initial deposit is not enough. Learn to understand risk and reward per trade. Successful traders often have a profit and loss goal on entering each trade. Also, make sure you manage your risk. Work out how much risk is acceptable to you and take it from there. Ensure you're...
So let's get started with building the plan. Now today I'm going to use the term security, but I might say the euro, I might say Facebook, I might say Google, I might even say Bitcoin. But I'm referring generally to all publicly traded financial instruments. Also, I intermix the terms investing and trading. We know the difference. Investors take a short-term trade, a short-term position, and investors are taking much longer-term positions. Now, I'm going to apologize before we start, because sometimes it sounds like I'm trying to give you a lecture. And I know you're all experienced, mature adults. Okay, so this is not a childish lecture, but building a plan, writing it down, keeping track of your trades and having this journal, to me, is so important. And too many traders just don't get it till it's too late. Now, I've been trading, as most of you know, for about 45 years. I haven't gotten rich, but I've made a nice life from it. But do you know what? I'm sitting here at my desk now, and I have index files of index cards from every trade I made 30 and 40 years ago. I have sticky notes everywhere. I have Post-its. I have notes on every single trade. Now today, life is a lot easier. We have Excel spreadsheets, we have workbooks, we have lots of things we can do, and then we can track and pull up everything. There's no card catalogs we have to keep track of anything anymore. You can search, on your spreadsheets and find everything and anything you need. So life is better. Computers gave us more tools to use, but the fact is you need to understand how important this is. In order to become a successful trader, you need to develop a written trading plan. And this is where I just saw all your faces turn from smiles to frowns. Because yes, you have to write this stuff down. Okay, you have to write it, not for me, not to give it to your buddy, because everybody's trading journal and everybody's trading plan is unique to themselves. Okay. And you don't have to start out with this great big written out dialogue or this script or these plans. Start out simple and keep adding to it over time. Okay. But nobody has the same needs. Every trader has different trading styles, strategies, risk tolerance, market experience. It's always better to develop one's own personalized trading plan and modify it as your experience grows. Now, if you go search the internet, you'll find a couple odd and end questionnaires that somebody's uploaded somewhere. And in fact, I put them together, and in your screen, you can see where you can download right now the combined trading plan handout. I've tried to put some stuff together for you. Okay. But if you search trading plans or Forex journal, you're going to find 100 articles or 1,000, and they all are rewritten and rewritten and rewritten to say nothing. They're 300 words of gibberish. Because it's not like a business plan where we have spreadsheets and software and programs, but it should be. But because it's so individualized that we just don't have such a thing. But sometimes there's a misconception that you need highly evolved market knowledge and years of trading experience to be successful. That's not the truth. Simple trading plans, simple risk management tools, you can master in no time flat. And you'd be surprised when you have simple strategies and you've worked them out. And one of the most important reasons to write this stuff down is you say in your head right now, okay, I'm going to trade chart patterns and I'm going to trade ascending and descending triangles, and this is how I'm going to do it. Okay? You've got it all kind of worked out in your mind. And when volume breaks above this level, and RSI does that, when stochastics does that, and I have a breakout of my chart pattern, I'm going to do this. Okay, it's all in your head. But when you write it down, you're going to realize you've skipped over steps or you've missed things. And you'd be surprised when you write it down how much it works out. Now, you guys know that I do financial education, financial content, and this is what I do for a living. Now, I write scripts for a lot of videos, and I'll write this script out, and I'll spend hours or days making it perfect. But then the next thing I do is I go record it with my voice. I'm not usually the voiceover guy, but I record, and I find that it doesn't flow. It doesn't make sense. I've skipped things. The words are too long, or it's awkward to say when you're pronouncing. It was fine to read. The only way you do that is by working it all out. And so please keep in mind. But if you think of a trading plan comparable to building a business, because trading is a business. And this is one of the things that makes you think of trading in a serious position, that it is business. So think of this as your checklist. But I'm going to ask you a question. If you decided for some reason you wanted to open a business, would you just put it all in your head, and would you go around trying to find investors and open it up and put your life savings in there? Somewhere along the line, you're going to be forced to write an introduction. You're going to be forced to write a proposal. You're going to be forced to figure out a business plan. So think of trading as a job or a business, and think of the things you'd have to put together in a business plan. I'm going to give you a hypothetical. For some reason, I don't know what it is, you've always wanted to own a women's clothing store. For some reason, you think you got the look for color, you know what it'll sell, you know everything, but you've worked a job all your life, you saved your money, you've been working hard, and you've got some money saved up, and you say to yourself, it's now or never, because I'm just going to be too old to ever do it. Now, kids are grown, they're off to university, got money in the bank, but you're sitting at the edge of your seat. Now, you're in the mall, and you walk past a shop that's got a for rent sign. And you take one look at that shop, and this is your dream come true. It is the perfect shop in the perfect location, the perfect spot in the mall for exactly what you want to do, what you have envisioned in your mind. Now, you quickly, and you've been thinking about this for a long time. And I'm sorry, this story gets a little bit long, but we're going to use this story throughout the class tonight. But you've been thinking about this for a long time. You have a lot of stuff kind of worked out in your head, and you need $250,000 to get this place open, just open. Between the build outs, what you figure your rent's going to be, what you figure, the inventory is going to be, to get the signs, to, all the stuff. But you only have like $75,000 in the bank. So you go home and you can call your folks. You can call your brother. You can call your best friend, and you do. And all of them say, fine, we'll invest in your business. We trust you. Okay. So guess what? You've got $250,000 of promised money. So now you think it's time to do the next step, because before I can do any planning, I got to secure this store, this location. So you go to the mall, you contact the real estate company, you go to the mall, and the guy from the mall says, Yeah, we'd like to have a women's dress store there. Here's the rent. Here's all the things. Here's our list, our book of 9,000 things you have to do and have in order to rent that shop. We need a business plan. You have to have a business account. We need your business ID numbers. We need credit sources. We need down payments. You need to have this insurance and that insurance. And, these are the hours you need to be open. These are the things you must participate. It goes on forever. Okay. So that's fine. You shake hands with each other. You give them a small deposit. Now you can start moving forward. You call the attorneys. The attorneys say, okay, what's the name? What's the corporation? We're going to do all the registration for you. We're going to take care of all the business end of this stuff, the legal end of the stuff. Okay. You got it, man. So guess what? You've now got your Forex trading account open. You've got your first deposit in there. You've done your ID verification, your AKC, your KYC, and you are ready to trade. Now, how do you start? You're just going to push the button and risk your money? So you've got to start somewhere. And even if you've already made your first couple of trades, you're starting out in this business, everybody needs to build this trading plan. And from there, you can tweak elements that might be weaker and not contributing to your overall goals. Ask yourself the following questions. The answers will assist you in the foundation of your trading plan. You should refer back to it regularly to make sure your plan is on track. If your immediate answer to why I am trading is to make money, you should stop right there. If the only goal is to make as much money as fast as we can, you're ultimately doomed because it will never be enough. Managing your loss should be your primary goal, protecting your capital, protecting your investment. This will create an environment in which profits can be generated. So where do I start? Well, you should begin your trading plan with your trading strategies. Okay? You have to have some idea of how you're going to trade. If you're on a trading platform, you got money in an account, and you have no idea of how you're going to make your decisions, you're in trouble. You need to get away from that account and go learn something, because you have to have at least one basic strategy, one basic idea of how you're going to make a trade. May not apply to many trades, but you need to have somewhere to start with. So if you are trading price action setups, you're trading key structure levels, you're structure trading or using advanced patterns, and you should put them down first. That should be the first step you write on your trading plan. What am I going to use to make my trading decision? This will act as a blueprint for what you need to do each time you interact with the markets. Okay. Now, when you write it down and figure it out, whether your buddy told you this and the guy on TV told you that and the guy on the internet told you that, figure it out. Now, in addition to your strategies, you need to put in your risk tolerance and your money management rules. Having written strategies with your risk tolerance and money management is like having a market blueprint. This blueprint is essential for developing the discipline that will lead you to the road of success. Now, like I said, there's very little worthwhile that I could find on the internet to give you a trading plan. But I did put together a video presentation for you that I'm going to share with you now. And hopefully it'll give you some little bit better idea. And then we're going to start talking about building your business.
Should keep in a trading journal. Why is this important? A trading journal records your trading results, allowing you to assess the overall performance of your trading decisions. This information can prove critical, especially in times when you may be experiencing negative results in your trading. During these times, there is no clear reason as to why your trading results are poor. Your confidence can be shaken. You may ask yourself, has the system stopped working? When should I stop trading with this system? Should I just keep trading despite the losses? Not having the answer to these questions can lead to fear and affect your trading. Using a journal allows you to look over previous results and find if there is anything unusual happening in the markets, or whether you are deviating from your system. For the journal to serve its purpose, it is important to record the correct data. This includes a record of all trades you have taken and an indication of how those trades have performed on an individual and an overall basis. Many traders use a spreadsheet because they can be easily analysed and they provide useful information, such as the overall profit and a visual equity curve. An equity curve provides a visual indicator of the overall performance of a strategy. This information can prove invaluable when doubts start to creep into your mind, because a quick glance at the equity curve can restore confidence and keep you on track. You should also record your thought process at the time of each trade, including what you may have been thinking about, how you are analysing the markets, and why you decided to take each trade. It is possible that your judgment is affected by certain things going on in your life, which would be highlighted more clearly when going back over the journal. If, for example, you make poor decisions when something is happening in your personal life, then you will know to avoid trading at such times. It is also important to take a screenshot of the entry and the exit. Not only can you see how well the system is doing by the journal data, but you can also see how well you are adhering to your system when you look back, or whether the system breaks down under certain market conditions. There may be indications from a screenshot that you can use in order to find better entries or to tweak your system. So far, you have learned that a trading journal helps you to stay focused in your trading. You should record all of the trading data as well as their results in a spreadsheet so you can analyze them at a later date. It's vital to record the system data and your own feelings when analyzing each trade. This may highlight times when you have things going on in your life that adversely affect your trading, and you can avoid trading at these times.
Now, if I ask 100 traders that have come to my classes over the years to send me a copy of their trading plan, I guarantee it'll be the highest rejection level event of my life. I don't think anybody's ever sent me one. I'm not going to critique it. I just want to see what they've included. But unlike business owners who generally have a business plan in order to provide a strategic vision to employees and to stay focused on their primary line of business, most traders never take the time to create a business plan. Now, let's go back to my dress shop. Well, things are just moving along nicely. Now, you've never taken those thoughts out of your mind. You've raised the money. You got the okay for a lease. The lawyer's drawing up the paperwork for the names and the legal and the tax stuff. Well, what's the next step? Got to put the money in the bank so you can start paying the bills as you commit to this stuff. You've called the insurance company. They tell you they need $10,000 for the the employee insurance plus the mall insurance plus all the other things you have to be insured. The landlord's told you he needs a deposit of say $25,000. First month, last month, 3 months of this, 2 months of that, 1 month of that. The lawyers want $5,000. So what's the time to do? It's time to call mom and the friends and everybody else who pledged money to you and bring it in so you can have it. Well, you call everybody together and you say to everybody, well, guys, it's time to kick in your money. Everybody pats you on the back and says, we're more than glad to give it to you. But are we investing in your business? Or are we loaning you the money? How are we going to get it back? When are we going to get it back? Is there interest? Are we profit sharing? Do we own stock? What is all? Well, you never thought about it. You just told your mom you need $50,000. She'll write you a check. But now she wants to know what she's writing the check for. Same thing with your brother or your friends. Well, now you got to think about it. You got to write it down. You got to start building something because they also want to know when they're going to get it back, how they're going to get it back. Is it going to be monthly payments? Is it going to be part of your profit? Is it going to be, are you going to have meetings once every 90 days to share all the updated data with them? So Now you got to start pulling this stuff out of your head and putting it on paper. Same thing when you're trading. Now, as I mentioned, there are already a million articles on the web about trading plans, but there's none worth reading. Okay, that's the problem. They're all content people that have been paid a couple dollars to write 400 words on trading plans, and they all look at the prior one and write the same stuff. So things you have to include, where to start with. Now, I'm not talking about, because you need a big trading journal, what you're going to do in the morning, what you can do in the afternoon. My trading plan restricts the hours and the days of the week I can trade. Okay, because I don't want to be owned by the markets, but this is me. Okay, because you know what? If you start doing that, you'll realize that the market is completely different on Wednesdays than it is on Tuesdays. It's completely different at 9 a.m. than it is at 4 p.m. Well, if you start to understand that, you'll start to be able to focus your trades. And when you start to understand the personality of the assets you're doing, the personality of the markets, you become a much better trader. It's no different than you getting in the car and running to your office. After a while, you know exactly what route to take. And if this highway's backed up, to jump off there, you know exactly what time. And you know if you leave your office at 4:30, you can get home faster on route number 2 than you can get on route number 4. But if you leave your office at 5:30, you know it's going to take you an hour and a half to get home instead of 25 minutes. Okay. We know this stuff. How do we know this stuff? You didn't wake up in the morning knowing this stuff when you first got the job. But after the years of driving back and forth to the job and knowing the streets and the roadways, you know it instinctively. But if your boss said, yeah, I need you to come in Sunday at 2 o'clock, would you know it instinctively on Sunday at 2 o'clock? Because you've never gone to the office on Sunday before. So keep this in mind. Now, you may say, this is a lot of work and I just want to get out and trade. I'm not making money. Well, you know what? In trading, time is one of the few places that its time is irrelevant. When you're opening up that mall, that store in the mall, from the day you sign that lease, you're paying rent, you're paying electric, you're paying all the overhead, you're paying the insurance, you're paying everything. Not in trading. You open up the account, you got your KYC done, you got your money put there. That money can sit there for months. Nothing happens to it. It's got no expense attached to it. So you can start trading. You can stop your trading now and start trading more later. You can increase your trading whenever you're ready to. Okay, because you're not losing money. It's not like your money's going to go away, and there's always more trades. So the first and most important thing is, once you wrote something down, is how you evaluate it. Now, for me, I stop and evaluate every 10 trades. I turn them over and inside out and upside down, and I evaluate everything. Now, that's for me, not for you. Because on the average, it'll take me approximately 3 months to place 10 swing trades, or 4 days to place 10 day trades. But I live in this market. I work every day in this market. If I had a full-time job and I was trading part-time, I might get 2 or 3 trades in a week. Okay, so it may be, it's completely up to you. So what is the magic number for you to evaluate your trading activity? And we mean, when you reach that number, you stop everything. Every trade is closed. No trades are up until you write down everything. You evaluate everything. You turn it upside down. Because here you go. You got your mall store. You paid everybody. It's getting closer to time to open. And unless you have a checklist that you're checking, you're going to come the day to open. And guess what? The girl who's opened the store for you tomorrow, you never gave her keys. You never gave her the burglar alarm code. You forgot to give her the computer code. You don't have money and cash in to register. You forgot to finalize the deal with the credit card company. These are all things you have to check on all the time. So you want to identify your key matrix, but you want to keep it simple. Don't overcomplicate stuff. Now, just like your mall store, you have to identify the assets you want to trade. You've decided you're a dress store, but you're going to be just teenagers, middle age, old age. You're going to be fat, slim. Are you going to be hip? You're going to be cool. You're going to be, housewife. You got to decide what the image is for your store. Just like here, you have to identify the assets you're going to trade. One of the worst things about online trading is it gives you too many choices. And I meet too many traders that are trading Facebook 1 minute, trading the euro the next minute, trading Bitcoin the next minute. You can't possibly cater all of these. It's just like the store. He's got a dress in the window that appeals to some girl going to prom, and then he's got a dress in the window that appeals to a 70-year-old. Well, you're never going to attract people that way. You got to isolate what you want to be an expert at, what your branding is, and set your goals, stick to it, and reach those goals. Because remember, a goal without a plan is just really a wish. Figure out your trading strategies. And now I'm going to share with another quick recording that we're actually going to show you how to put it together on a journal. Okay. And what data to record.
Working with a trading journal. In this lesson, you will learn how to collect and analyze trading data, what you should know after collecting at least 30 trades, what you should know after collecting 100 trades, what are benchmarks, what is a benchmark breach, and what should you do if one occurs. Before trading a strategy on a live account, experienced traders will test a system using a demo account. You can use a spreadsheet to store the data and analyze it in order to ascertain whether the strategy is profitable over a sustained period. In order to do this, you need to record the correct data. First of all, you need to record the time and date of each trade. This is needed so that you can check and reference your trading after your trading session has finished. There may be times where your strategy is not particularly profitable, such as specific days of the week or particular times during the day. You can ascertain this by recording the time and date of your trades. This data is especially helpful to see how the price action looked at the time when you entered a trade on your chart. The next thing you need to record is the currency pairs that you trade. This is necessary in order to know which pairs are profitable and which are not when trading them with your strategy. You may need to remove unprofitable pairs from your system or explore new pairs to be incorporated into your future live trading. Next, you must always record the entry where you place your stop loss and the price at which you closed your trade. Recording these will make it easy for you to check the risk to reward ratio for individual trades and will ensure that you continue to adhere to correct money management. You can also observe, over time, whether your risk per trade is staying within an expected range or becoming higher with individual trades. If so, you can investigate whether this is simply the result of changing market conditions or if you are deviating from the rules of your strategy. It is important for you to record the final results of your trading in pips, percentage gained on the trade, and the cash value. This allows you to keep a check on the profitability of the strategy over time. For instance, you may notice that the system is becoming gradually less profitable. This could be the result of changing market conditions or of not following the rules of your system. Either way, you can investigate whether the strategy is either worth pursuing in changing market conditions or whether you need to make some adjustments to your trading. Now that you have an idea of what to record in your trading journal, we can show you how to use this data further and turn it into meaningful information. Firstly, you can assess the combined overall profit or loss of the system. This is essential in determining whether the strategy is profitable overall. This will help you through losing streaks because you can refer back to the overall profit for confidence. The total amount of trades taken is a significant factor for either developing confidence in your system or deciding whether the system is worth pursuing. If you can see that after a small number of trades you have made a loss, you can still continue trading because you have not taken enough trades to assess the system properly. On the other hand, if you can see that you have made a loss on your account over a significantly higher amount of trades, then you may feel that the strategy simply does not work. Determining the distribution between the system's winners and losers will help you deal with future losing streaks. If the system makes money, but only has a small percentage of winning trades, then you can continue to trade confidently when losing streaks occur, because you know this is normal for the strategy being used. However, if your system is losing money with a higher percentage of winning trades, then you have highlighted that there is something wrong with the risk management aspect of the system. Knowing the average risk and average reward is vital, so that expectations can be more aligned with the reality of the performance. If your risk on individual trades begins to vastly exceed that of your average reward, then you may have to assess your system and see whether market conditions are changing or whether you are adhering to your strategy. Every trading system should be tested with at least 30 trades. This is because many systems have losing streaks, and you need a relatively decent sample size to initially assess if the strategy is or is not profitable. If a trading system is not profitable over 30 trades, it is likely that modifications are required, or the system is simply not worth using with real money. If this is the case, you may want to find an alternative strategy to test in the same manner. If the strategy is profitable over 30 trades, then you can continue with the testing of that strategy. Once you have shown that the strategy is worth pursuing after 30 trades, you can test the system more extensively over 100 trades. If the strategy is profitable over 100 trades, you can then feel confident taking the strategy to a live account. With 100 trades, you can also ascertain the following. How often do losing streaks tend to occur? What kind of drawdown does the system produce? What is the ratio of winners to losers? A benchmark is the maximum negative impact you will allow to have on your trading system. For example, it may be the maximum amount of trades suffered in a losing streak, or the maximum percentage drawdown that the system has suffered. You create your benchmarks by observing the data you have collected while testing the strategy, and using the worst result from that testing. So, for example, if the maximum percentage drawdown of your trading account was 10% while testing your system, then this is the benchmark when trading with a real account. You can then consider any drawdown as a natural part of your strategy, until your drawdown exceeds the benchmark of 10%. When a benchmark is broken, however, then this is the point when you stop trading on a real account and assess the strategy again. This means going back to a demo account and testing the strategy over 30 trades. If the results or the retesting are positive, then the benchmark can simply be adjusted and live trading can continue. If the trading results continue to be negative, then you may have to assess whether your strategy is still worth using. You may need to continue.
Now, as I said earlier, that's a lot of work, but it's the only way you're going to become a successful trader. Now, when you stop to think about it, a football or soccer player getting paid millions of dollars a year, okay, why do they have to practice? Why do they go to scrimmages? Why do they go every day to the field and work in the locker room, mastering and watching their opponents? Why do they look at every other play? Why are they constantly practicing on the field? They're making millions of dollars. They got to be the best footballers out there. But they only do this by testing, practicing, rehearsing. So if you think of the practice or the scrimmage as your demo account, and everything is being watched and analyzed in its entirety. And then every time you're meeting another team who you haven't played in a while, you're doing all of this and evaluating them and strategizing them and knowing what the players that'll be put up against you, what their plays are. Okay. If a guy who's a professional athlete's got to do this, why don't you? Okay, so it sounds like it's boring and humdrum. Now, once you've got your demos and your trading journal and you got your plan or your strategy written down, you have to determine how you're going to place your stop losses, how much you're going to risk per trade, what your exit strategy is going to be. Every one of us have different exit strategies. Like for me, I use trailing stops and I will split my trade. Once it's gone and made some profit, I'll close out half my position, book that profit, move my stop up closer and keep pushing and pushing. But that's my exit strategy. You need to have yours. Also, what would happen if you're in this trade and it's beautiful? What things will you be looking to happen in the market to tell you to get the hell out now? Okay, you need these things to say. You're not going to think about it. Look at when this happens, I'm closing my trade regardless of what. Okay, when you write it down, you've got the success factor, because pulling it all out of your head and putting it on paper and making it steps that you follow are your keys to success. Okay, how much money you'll risk per trade. Money management is ultimately important. How much money will you have in the market in multiple trades at any given time? When will you take breaks? Okay, breaks are not holidays. Breaks are not vacations. Breaks are when you say, you know what? Guess what? Platform, trader, day trader. You say, guess what? I'm in control. You're not in control. I'm going to shut my computer down and I'm going to take the day off and not look at the markets today. That's when you take back control. You can get your emotions out of the market. Also, we have this old saying about limit up, limit down. If you start out your day and made a couple trades and made a lot of money, guess what? Close your computer, close your platform, go take a day off, go fishing. Because when you have a very successful run in a very short time, you get cocky. You'll make trades outside of your trading plan. Because I made $1,000 this morning, so I can risk 600 instead of 200 on this trade. Before you know it, you lost your profit. Same thing happens inversely. Your first couple trades during the day are absolutely terrible. Close your computer, walk away from it. Because otherwise you're going to start chasing your money. Always come back with fresh eyes, fresh ears. But you know, you need to start out somewhere, and you think this is ridiculous, but you have to. Okay, you need to have notes, you need to have history, you need to have documentation, you need to have analysis. Today's world is a very difficult place to be successful in, and if you want to be successful, you have to put the time and the effort into your work. So thank you very much for joining us today. If you want to learn more about building a trading journal and a trading plan, go to Legacy FX, go to their education center. They've got lots of material for you, or you can contact Legacy and one of their account managers or their technical analysts will talk to you and help you start yours off correctly. So have a great trading day. Thank you very much for joining us, and we'll talk to you again real soon. Bye now.